Imagine holding a stock in a just a standard boring vitamin company. You bought it because you wanted something safe.
Right, something highly predictable.
Exactly, safe and predictable.
Wow.
But then you check your mail, and along with your normal cash dividend, this vitamin company has sent you like a travel voucher for a vacation.
Oh, wow.
Yeah. And a discount for a restaurant, and a gift card for a local department store.
That's a pretty heavy mailbox.
It is. And when you actually sit down and do the math, the total shareholder yield sitting right there in your mailbox is a staggering 38%.
38%. That's massive.
Right. Today we are finding out how a health food company morphed into this sprawling corporate conglomerate, and more importantly, whether that 38% yield is a stroke of financial genius or, a massive red flag.
Well, it definitely demands a closer look.
It really does. Welcome to the Deep Dive on the Japan Stock Podcast. We are looking at the source material for AFC-HD AMS Life Science, ticker symbol 2927.
And we have a really fascinating set of financials and corporate reports to unpack today. Because on the surface, it really does seem like a chaotic mix of assets.
Just completely random businesses bolted together.
Right. But if you look closely at the balance sheet and the profit and loss dynamics, a very deliberate strategy actually emerges.
Okay, so there is a method to the madness.
There is. We are going to decode how they are using a massive cash-generating core business to basically consolidate market share, fund ambitious acquisitions, and target a 10% return on equity.
And my job is to translate all those corporate finance mechanics into plain English for you. We are going to break down the actual strategy, push back on the numbers, and figure out what this means for, someone actually looking at this stock.
Sounds like a plan.
So let's start with the big picture here. When you say chaotic mix of assets, what is the true identity of AFC-HD? Like, what does the blueprint actually look like heading into 2026?
So based on the 2026 interim revenue structure, the company brought in 16.84 billion yen in total sales.
Okay, 16.84 billion. Got it.
Right. And the dominant engine of this whole operation, making up 36% of that revenue, is their healthcare OEM division.
OEM, meaning original equipment manufacturing, right?
Exactly. They are essentially a giant white label factory. They manufacture the health supplements, the vitamin pills, the functional foods that other brands just, slap their own logos on.
So they own the factory, but not necessarily the brand risk. They're the ones actually pressing the pills on the floor.
Precisely. They do the heavy lifting.
Okay, so that's 36%. What makes up the rest of that 16.84 billion yen?
Well, that is where the diversification really kicks in. 13% comes from the department store segment, which is primarily the historic Saikaya department store.
Wait, a department store?
Yeah. And then 12% is their own brand healthcare. 10% is overseas healthcare. 8% is pharmaceuticals.
Okay, pharmaceuticals make sense for a vitamin company.
Right, but then 7% is food and restaurants. Another 7% is real estate and construction.
Real estate, too.
Oh, and the final 6% is this bucket of miscellaneous ventures, which surprisingly includes operations like a Japanese language school and a food service business in Vietnam.
I have to stop you right there. Because to a retail investor, that sounds less like a highly strategic business and more like a CEO who just, went on a shopping spree.
It definitely looks scattered.
Right. A vitamin manufacturer running a language school and a department store, it sounds completely unfocused.
It raises eyebrows for sure. The miscellaneous ventures are largely legacy projects or just small opportunistic plays. But the core strategy underneath it all is much more structured.
Okay, how so?
Think of the OEM manufacturing division as this massive, stable power plant. It just churns out reliable cash flow month after month. Management is taking that excess capital generated by the power plant and using it to acquire struggling, distressed assets.
Like the Saikaya department store you mentioned.
Exactly. They buy them at a steep discount with the ultimate goal of turning them around.
Ah, I see. So they are essentially acting almost like a private equity firm, just using the cash from the pill factory to fund all these turnaround side quests.
That is a great way to look at it.
Well, let's focus on that power plant for a minute then, because if the OEM business is funding literally everything else, we need to know just how strong it actually is. How big is this market in Japan?
The total market size for health food OEM in Japan for 2024 was estimated at around 176.1 billion yen.
Okay, so a fairly large pie.
It is. But the crucial metric to watch here isn't just the size, it's the velocity of their market share capture.
What do you mean by velocity?
Well, in the 2019 and 2020 timeframe, AFC-HD held about a 5.3% share of that market. Fast forward to 2024, and they have climbed all the way to the #4 spot nationally.
Wow, really?
Yeah, commanding an 8.1% share now. In a highly fragmented manufacturing sector, jumping nearly 3% in market share is a massive relocation of capital.
Okay, but they didn't just stumble into the #4 spot by accident. Moving the needle that much in manufacturing usually requires either buying up all your competitors or, well, someone else failing miserably.
It's mostly the latter, actually.
So what is driving everyone else out of the market?
It comes down to a really significant change in the regulatory environment, which has, somewhat inadvertently, created this massive economic moat for AFC-HD.
Okay, regulatory changes. What happened?
In April 2024, the Japanese Consumer Affairs Agency enacted significantly stricter rules regarding functional foods.
And what did those new rules actually change on the ground for these companies?
Prior to 2024, the threshold for claiming a health benefit on a supplement was relatively loose.
It's pretty easy to just put a label on a bottle, right?
Exactly.
Yeah.
But the new regulations changed the game entirely. Now, companies must provide rigorous clinical trials, robust scientific evidence, and they have to implement rapid post-market surveillance.
Wait, surveillance? Like tracking side effects?
Yes. They have to report any adverse health events immediately. They basically brought the compliance standards for functional foods much, much closer to actual pharmaceuticals.
Let me just visualize that for a second. If you're a small mom-and-pop supplement brand, your overhead just completely exploded overnight.
It went through the roof.
You can't just, mix some vitamin C in a vat in your garage and sell it on the internet anymore. You suddenly need a $1 million compliance department, a whole team of lawyers, and a direct line to a testing laboratory just to keep your gummy bears on the shelf.
That is the exact friction point right there.
Right.
Compliance is a fixed cost.
Right.
So if you have an 8% market share like AFC-HD, you can spread that massive legal and R&D budget across millions of units. It just becomes a tiny fraction of a yen per pill.
But if you're a tiny brand...
If you only have a 0.5% market share, that same compliance cost will literally bankrupt you.
Okay, I get it now. So the smaller clients are basically fleeing to AFC-HD because AFC-HD already has the lab coats and the lawyers in-house.
Exactly. By outsourcing the manufacturing to them, the smaller brands are essentially outsourcing the legal liability and the regulatory headache.
Wow. They are turning government red tape into a customer acquisition strategy. That is actually brilliant.
It is. The stricter the government gets, the more valuable AFC-HD's infrastructure becomes. It forces the undercapitalized manufacturers to close their doors, and AFC-HD just absorbs all that orphan demand.
That makes perfect sense for their domestic moat. But let's pull out the magnifying glass and look at the most recent data, the 2026 interim results.
Right, the fresh numbers.
Yeah. If they are gobbling up all this market share, the numbers should be absolutely flawless.
Well, not entirely flawless.
Uh-oh.
The first half of 2026 revealed a pretty crucial speed bump. Overall, top-line sales grew slightly, hitting 101% year-over-year. However, operating profit actually dropped.
Dropped. By how much?
It fell to 1.25 billion yen, which represents only 97% of the previous year's figure.
Wait, sales are up, but profits are down. As an investor, that is usually the very first sign of margin compression. Where's the leak? Is the core OEM business slowing down?
No, the core business is remarkably stable. The domestic OEM segment grew to 102%. Pharmaceuticals posted a massive 173% growth.
Okay, so the power plant is fine. Where did the money go?
The drag on the profit margin came entirely from the overseas healthcare segment. Its operating profit plummeted to 53% of the previous year.
A drop to 53%. That is severe. Their most lucrative, high-margin international business basically just got cut in half.
It did.
Should we be panicking about a structural failure here? What does a hit like that do to their earnings per share for the rest of the year?
It is a material hit to short-term margins, yes, which naturally puts downward pressure on EPS. However, analyzing the balance sheet shows this is likely a transitional phase rather than, a terminal decline.
A transitional phase. How so?
Management is actively deploying capital to restructure their capacity. They are running heavy capital expenditures right now to address deeper structural issues.
Okay, what kind of CapEx? Where is that money actually going?
They are pouring significant capital into their primary Chiba factory. Specifically, they are constructing a massive new warehouse and shipping facility.
In Chiba?
Right, slated for completion in the autumn of 2025. This project is designed to drastically improve throughput. But more importantly, they are aggressively investing in factory automation.
This comes back to the labor shortage in Japan, doesn't it?
It is the single biggest bottleneck in Japanese manufacturing today. You can have all the new OEM orders in the world flowing in from your competitors dying off. But if you do not have the physical human operators on the factory floor to actually run the packaging machines,
Your top-line growth just hits a brick wall.
exactly, you hit a ceiling.
So they are replacing human hands with robotics, which hurts the cash flow right now because you have to buy all the expensive robots up front.
Right, the CapEx drag.
But once they are installed, your marginal cost of production completely plummets.
And it essentially decouples your production capacity from Japan's shrinking domestic demographic.
That is huge, but that actually brings up the larger strategic issue, right? If the domestic population is shrinking, even with robots doing the work, the consumer base in Japan eventually has a ceiling. They have to expand overseas.
They absolutely do.
Which brings us back to that massive drop in the overseas segment. If their international profit just got cut in half, how do they plan to fix it? Do the source materials give us any indication of a long-term geographic pivot?
They do. And it involves a very specific high-barrier geopolitical strategy.
I love the sound of that.
While current overseas profits took a localized hit, they are laying the groundwork right now to aggressively target the global Islamic market.
The Islamic market. Okay.
In November 2024, they secured a major catalyst. They received official halal certification from the MUI, that's the Indonesian Council of Ulama, specifically for their processed drinks.
Oh, wow. Let's break down why that matters. Because the MUI certification isn't just a label you can buy online. Explain the actual friction of getting halal certification for a health supplement. Why is it so notoriously difficult?
It is an incredibly rigorous auditing process. To receive MUI certification, a manufacturer must prove that every single ingredient, every raw material, and literally every piece of machinery on the factory floor is free from cross-contamination with non-halal substances.
And in the supplement industry, that's really tough, right?
It's exceptionally difficult because common ingredients like the gelatin used in pill capsules are very often derived from pork or, non-halal slaughtered cattle.
So they basically have to completely overhaul their supply chain, find entirely new, certified raw material vendors, and then prove to these auditors that not a single trace of contamination occurs during the entire manufacturing process.
Right.
That takes years and millions of yen to pull off.
Which is precisely why most of their competitors don't even attempt it. But by leveraging the exact same strict Japanese quality control systems they had to build to satisfy those domestic regulations we talked about.
Ah, the consumer affairs rules.
Exactly. They use that same infrastructure to clear this massive international hurdle.
And once you actually have that certificate on the wall, it becomes a golden ticket. Indonesia is one of the fastest growing, youngest consumer bases on the planet right now.
It is a massive demographic shift.
By securing the MUI certification, AFC-HD totally separates itself from lower-tier Asian manufacturers. They can export their Japanese-made products into a booming market and command a premium price.
Because they have the absolute highest level of religious and safety compliance, totally verified.
That is an elegant use of their existing infrastructure. They built the compliance engine just to survive in Japan, and now they're using that same engine to unlock a demographic that is expanding rather than contracting.
It's textbook adaptation.
Okay, that covers the operational moat beautifully. But I really want to pivot to the financial reality for the people listening to us today because we need to talk about their capital policy. Let's look at the return on equity, or ROE, and figure out how we get to that wild 38% shareholder yield.
Good, because ROE is the critical metric here. It measures exactly how efficiently management is using shareholder capital to generate profit. And AFC-HD has experienced a significant roller coaster in this area.
Walk us through the numbers.
In 2021, they achieved a very strong ROE of 13.4%.
That's solid.
It was. But by 2022, that metric plummeted to 6.1%.
Okay, let's use an analogy for anyone not staring at a financial spreadsheet all day. Think of ROE kind of like your return on a rental property, right?
Sure.
In 2021, they had a nice, clean house generating really great rent, but then they decided to buy a massive fixer-upper at the Saikaya department store. So their total investment, or their equity, went way up. But that broken-down department store wasn't generating any high rent yet. So their overall percentage return just dropped across the board.
That is a highly accurate way to visualize it. The denominator, the equity base, expanded with these acquisitions. But the net income did not immediately scale to match it, which compresses the ROE.
Right.
Since that drop, Management has been methodically renovating those distressed assets, and they have publicly stated a target of returning to a 10.0% ROE by 2025.
And this is where the story gets really interesting for the retail investor. While they are busy renovating these businesses and trying to boost that ROE back to 10%, they are practically showering their shareholders in perks.
The shareholder benefits are quite unique.
To say the least, according to the 2026 forecast, let's say you buy just 100 shares. At recent prices, that is an investment of roughly 88,000 yen. For that, you receive an annual cash dividend of 3,600 yen.
Which is a 4% cash dividend. That's quite solid on its own in the current market environment.
It is, but the cash is literally just the appetizer here. On top of that, they issue 30,000 yen worth of shareholder perks every single year to that exact same investor.
Right, the vouchers.
You get discount tickets for their own health foods and cosmetics. You get 500 yen dining vouchers to use at their restaurant chains. You even get 5,000 yen travel vouchers for AFC tours. When you combine the cash and the monetary value of all those perks, you hit that astonishing 38.0% total shareholder yield.
It is a phenomenal return on paper. But as an analyst, it obviously requires intense scrutiny.
I completely agree, and I want to push back on this hard, because a 38% yield sounds like a massive red flag to me. Usually when a company offers a yield that high, it means the stock price has collapsed, the business is a complete value trap, or they are, liquidating the office furniture just to pay the shareholders.
It usually signals distress, yes.
Management is giving away 30,000 yen in perks to someone who only invested 88,000 yen. How on earth is this sustainable without just bankrupting the company?
The sustainability comes from understanding the difference between the retail value of the perk and the actual marginal cost to the company to provide it.
Okay, unpack that for us.
This is where corporate finance really intersects with consumer psychology. It is essentially an internal stimulus package. They are using their own retail investors to artificially generate foot traffic and revenue for their struggling subsidiaries.
Walk me through the mechanics of that internal loop. Let's trace the path of a voucher.
Okay, take the 5,000 yen travel voucher for AFC tours. The actual cost to the company to print and issue that piece of paper is near zero.
Right.
When the retail investor redeems it, they are booking a trip through a subsidiary that very likely has unused capacity. But here's the catch. The investor uses the voucher, but they also pull out their own credit card to upgrade their hotel room, buy meals, and pay for excursions.
Oh, I see it now. They aren't just buying loyalty, they're literally manufacturing their own customer. If you have a 5,000 yen voucher burning a hole in your pocket, you are not going to use a competitor's travel agency. You are going to book with AFC Tours. And the cash you spend on top of the voucher flows directly into the top line of that struggling subsidiary.
It is a closed-loop economy. The cash generated by the core health food business subsidizes the issuance of the voucher. The investor takes the voucher and spends it at the Saikai department store or the restaurant group.
And then what happens?
That new revenue is captured entirely within the consolidated balance sheet. It helps revitalize those specific acquisitions, which ultimately pushes the overall net income higher and supports that 10.0% ROE target we talked about.
It's like a bizarrely generous subscription box where the company is paying you to be their best customer. They are basically forcing their own shareholders to cross-pollinate the conglomerate.
Yes, they are.
It is brilliant, provided the core power plant keeps generating enough cash to fund the whole ecosystem.
And that right there is the pivotal vulnerability. The entire corporate structure is a very delicate balancing act. It is heavily reliant on the OEM division continuing to produce outsized cash flows.
Because if the power plant shuts down, the whole city goes dark.
Exactly. If the OEM engine stutters, whether from unforeseen regulatory shifts or just a failure to automate fast enough, their ability to subsidize those internal loops and fund the cheaper CapEx projects will evaporate very quickly.
So let's synthesize everything we've uncovered today. What is the ultimate takeaway for someone looking at this source material? AFC-HD, AMS Life Science is clearly far more than a company just pressing vitamin C into tablets.
At its core, it is a highly defensive, cash-generating OEM machine. They are strategically leveraging regulatory friction, specifically those April 2024 functional food rules, to consolidate the domestic market.
Right, absorbing the clients of smaller competitors who simply cannot afford the new compliance costs.
Exactly. And simultaneously, they are taking that strict Japanese quality control infrastructure and pivoting into the massive global Islamic consumer base by securing Indonesian halal certification. They are turning compliance into a premium export.
And they are using the massive cash flow from that exact moat to build automated facilities in Chiba, protecting themselves from Japan's demographic collapse. And maybe most surprisingly of all, they are using that same cash flow to fund a 38% shareholder yield, deliberately using retail investors to prop up the department stores and travel agencies they acquired.
It is a very complex narrative of adaptation, leveraging regulatory scars into corporate armor and utilizing literally every available asset, including the shareholders themselves, to drive growth.
Which leaves us with a really critical question, something for you to ponder long after this deep dive ends.
Yeah.
We can clearly see the mechanics of their closed-loop economy. We understand how the shareholder yield drives traffic to their own businesses.
Yeah.
But you have to ask yourself, is using your core health food profits to subsidize department stores and travel agencies truly a stroke of cross-selling genius that builds lifelong customer loyalty? Or is it a classic conglomerate trap that will eventually distract management, bloat the balance sheet, and drag down that 10% ROE target? Keep a very close eye on how that high-margin overseas segment recovers in the next quarter. That will be your leading indicator on whether this machine can actually scale globally.
A vital metric to watch, and really the ultimate test of their entire capital allocation strategy.
Thank you all so much for joining us and exploring the hidden mechanics of 2927 today. Until next time, thank you for listening to this deep dive on the Japan Stock Podcast.